There is a date on the calendar right now that most Singaporeans are going to sleepwalk straight past. And unlike most financial mistakes, this one cannot be fixed in July. It cannot be fixed in December. Once the clock hits midnight on the 30th of June 2026, a specific window closes permanently. For you, for your parents, for your future retirement income, and no amount of money can reopen it. That is the first deadline. There are more. And by the end of this video, you will know exactly which moves to make, in which order, before which date, and precisely how much money each one saves you. Let us start with the one that is burning right now. The first move costs 1 Singapore dollar. That is not a typo, $1. And it locks in a retirement benefit worth potentially tens of thousands of dollars for the rest of your life. Here is what is happening. On the 1st of July 2026, Singapore's statutory retirement age rises from 63 to 64. Buried inside that change is a rule that almost nobody is talking about outside of financial planning circles. Your SRS withdrawal age, the age at which you can access your supplementary retirement scheme savings without a 5% penalty and without full taxation, is permanently fixed at whatever the statutory retirement age was when you made your very first SRS contribution. Contribute $1 before the 30th of June 2026 and your withdrawal age is locked at 63 for life. Contribute your first dollar on the 1st of July or later and it locks at 64. And when the retirement age rises to 65 by 2030, which is already legislated, anyone who still has not made their first contribution will lock in at 65. What does 1 year earlier access actually mean in money? Your SRS withdrawal window runs for 10 years from your first penalty-free withdrawal. If you withdraw $40,000 a year over that decade, only 50%, $20,000, is taxable each year. At Singapore's tax rates, $20,000 of taxable income means you pay almost zero tax. Starting at 63 instead of 64 gives you 1 full extra year inside that zero tax window. For someone with a $300,000 SRS balance, that extra year could mean $20,000 of withdrawals that are effectively tax-free instead of taxed at your marginal rate. That window is worth far more than the $1 it costs to secure it. Open an SRS account today at DBS, OCBC, or UOB. Transfer $1, done. OCBC is currently offering up to $50 cash reward for opening and contributing before the 30th of June. The downside is $1. The upside is a permanently earlier retirement withdrawal age that cannot be reversed or purchased at any price after the deadline passes. If you already have an SRS account but have never made a single contribution, your account alone does not count. The clock is set by the first actual contribution, not the account opening date. Transfer the $1 before the 30th of June. The second move is the most powerful guaranteed return available to any Singapore tax resident, and the deadline is the 31st of December 2026. CPF voluntary cash top-ups to your special account or retirement account earn 4% interest annually, guaranteed by the Singapore government with zero market risk. That 4% is not after tax. It is 4% clean, because growth inside CPF is not taxed while it compounds. No fixed deposit, no Singapore savings bond, no investment-grade corporate bond comes close to that risk-adjusted return for money you are parking for retirement. The tax relief on top makes it even better. For every dollar you top up to your own special or retirement account, up to $8,000 per year, you get a full dollar-for-dollar reduction in your chargeable income. Top up another $8,000 to an eligible family member, a parent, parent-in-law, grandparent, or spouse, and you get another $8,000 in relief. $16,000 of tax relief in a single year. What does that mean in actual cash? If you are in the 15% tax bracket, $16,000 of relief saves you $2,400 in tax. At 18%, it is $2,880. At 22%, it is $3,520. That tax saving arrives in addition to the 4% return compounding inside CPF. One important rule change that took effect in 2026, if the family member you are topping up is eligible for the matched retirement savings scheme, the government scheme that matches dollar-for-dollar top-ups up to $2,000 a year for eligible seniors, Those matched top-ups no longer also qualify for tax relief. It is one or the other. If your parent qualifies for MRSS matching, top up $2,000 to get the free government match, then decide separately whether to make additional top-ups above that amount for your own tax relief. The money must land in CPF by the 31st of December 2026 to qualify for YA 2027 tax relief. CPF transmits the data to IRAS automatically. You do not need to claim it manually. One final point. Top up in January, not December. A top-up made in January 2026 earns 4% for the full 12 months. The identical top-up made in December 2026 earns 1 month of interest. Same tax relief, very different compounding outcome. The third move is the one most Singaporeans know about in theory and never actually do in practice. Also a 31st of December deadline. SRS contributions reduce your taxable income dollar for dollar up to $15,300 per year if you are a Singapore citizen or permanent resident, and up to $35,700 if you are a foreigner. Every dollar you put into SRS is $1 removed from your chargeable income before IRAS calculates your tax bill. For someone earning $100,000 a year, contributing $15,300 to SRS drops their chargeable income to roughly $84,700. At Singapore's progressive rates, that is a direct tax saving of approximately $2,300 in year one, and the money inside SRS grows tax-free until you withdraw. At withdrawal, only 50% of the amount is taxable, and if you manage withdrawals across 10 years, starting at your locked-in SRS retirement age, you can structure it so the effective tax rate is near zero. Here is what most people get wrong. They open the SRS account and leave the money sitting in cash at 0.05% interest. According to MOF data, 19% of total SRS contributions, approximately $3.9 billion, is sitting idle in cash as of end 2024. That is not a retirement strategy. That is a tax relief claim attached to a savings account earning less than inflation. Once your SRS funds are in, invest them. STI ETF, Singapore REITs, Singapore Savings Bonds, T-bills, all available inside SRS through your bank. The tax wrapper only delivers its full value when the money inside it is actually compounding. Contribution deadline, 31st of December 2026. Each bank has its own cutoff time for year-end digital transfers. Do not leave it to the evening of December 31st. The fourth move puts real money back in your pocket, and most Singaporeans executing it completely wrong, which means they leave the deduction behind. Singapore gives you a 250% tax deduction on qualifying donations to approved institutions of a public character. Not a tax credit, a deduction of 2.5 times the donation amount from your taxable income. This enhanced rate has been extended until the 31st of December 2026. If you donate $1,000 to an approved IPC, $2,500 is removed from your chargeable income. At 15% tax, that $1,000 donation costs you only $625 after the deduction. At 22%, the same donation costs you $450. You are giving money to a cause you care about and reducing your tax bill at the same time. The critical distinction: it must be a donation to an organization with approved IPC status. Not every registered charity qualifies. Check the charity portal at charities.gov.sg before you transfer a single dollar. If the organization is not listed as an IPC, the deduction does not apply. Also, the donation cannot come with a material benefit to you in return. Event tickets, auction prizes, charity dinner seats, those are not qualifying donations. The full amount of a genuine gift to an approved IPC with no material benefit returned is what qualifies. You do not need to do anything at tax time. Approved IPCs submit your donation information to IRAS electronically using your NRIC or FIN. Check your Notice of Assessment to confirm it was captured. The fifth move is about checking what you are already entitled to and claiming it before it disappears. Every Singaporean parent, spouse, or family caregiver may be sitting on thousands of dollars in unclaimed tax relief right now. Parent relief for a parent or grandparent who is living with you is $9,000 per parent. For a parent not living with you but supported by you, it is $5,500. Handicapped parent relief is $14,000. Spouse relief is $2,000 if your spouse earns $8,000 or less per year. Grandparent caregiver relief is $3,000 for working mothers who have a parent or in-law looking after a child 12 or under. These reliefs are not automatically applied for everyone. You need to have filed them or verified them during the tax filing window from the 1st of March to the 18th of April 2026. If you missed the window for YA 2026, put the 18th of April 2027 in your calendar right now as a hard deadline, not a reminder, a deadline. One critical update for YA 2026. Course fees relief has been permanently removed. If you were planning to claim up to $5,500 for approved course fees, that relief no longer exists from this year forward. The government's position is that Skills Future Credit already provides direct funding for training. Which brings us to the final move. The sixth move costs you nothing and requires only the time it takes to log in with SingPass. Every Singapore citizen aged 25 and above has a Skills Future credit balance of at least $500 sitting unused in a government portal right now. Citizens aged 40 and above have an additional $4,000 in mid-career credit. This is not a voucher that expires with a product you did not want. It is money allocated specifically for your professional development, with no expiry date on the core balance that the majority of eligible Singaporeans have never touched. The one-time $500 top-up from 2020 provided in 2020 expired on the 31st of December 2025. If you had it and did not use it, it is gone. But the base $500 opening credit and the $4,000 mid-career credit for those 40 and above remain available indefinitely. For employers, the Skills Future Enterprise credit of $10,000 per company expires on the 30th of November 2026. That is 90% reimbursement on qualifying workforce training costs. If your company has not used it, you have weeks before it disappears permanently. Here is the full picture. Two different kinds of financial damage happen in Singapore. The first kind is slow. Bad investment returns, inflation, lifestyle inflation eating your savings. You can recover from slow damage with time and discipline. The second kind is permanent. A deadline passes, a window closes, and no decision you make in July or January or 5 years from now reopens it. The 30th of June is that second kind. $1, 10 minutes. A permanently earlier SRS withdrawal age for the rest of your life. Every other move in this video, the CPF top-up, the SRS contribution, the IPC donation, the family reliefs, has a December or April deadline. You have time to plan those. You do not have time to plan the SRS lock-in. That one closes in days. Open your bank app right now. Navigate to SRS. Contribute $1. Then come back and plan the rest. That $1 is the most asymmetric financial decision most Singaporeans will make this year. If this video gave you a move you had not made yet, hit the like button and subscribe. See you in the next one.